All right, everybody, just over 10 minutes remaining in today's trading session. Joining us from the floor of the Chicago Board Options Exchange, back with us, Judd Pyle, portfolio manager for Peak 6 Advisors. Judd, by the way, has 15 years of experience trading, analyzing, and managing risk and equity options and other derivative positions. Also back with us, Barry Knapp. He's head of equity strategy over at Barclays Capital. He's among the most accurate forecasters for the stock market this year. He recently, by the way, upgraded his year-end target for the S&P 500 to 1250. Barry says stocks could even top that if economic data continues to beat expectations. Guys, great to have you here with us. Hey, Barry, I'm going to kick it off with you because we're all talking about this open letter to Ben Bernanke that basically he's got it all wrong. He's got to stop, turn off the spigot. I mean, what do you think? Are the people right? Are his critics right?
Well, I suppose if the data were to get stronger to the point where the unemployment rate was in a sustainable downtrend, then I suppose you could make that argument. But it seems to me we're going to print a core CPI number of something like 0.7% annually on Wednesday, I guess is when CPI comes out. So that to me, with a 9.6% unemployment rate that hasn't moved all year, certainly makes an argument that the Fed ought to be doing something. Now, you know, again, we could have long arguments about whether expanding the balance sheet is effective or not effective. But given their dual mandates, I certainly understand why they're taking action at this point. And I think some of that criticism is a little bit confusing in the sense that nothing really else is being offered other than, say, fiscal policy, like tax cuts and the like. And I would think that those people really aren't watching Washington very closely if they really think that's a likely outcome with this administration.
Hey, Barry, not that bonds are kind of on the back burner these days, but I mean, the 10-year bond yield went up like 16 basis points, and that's a huge move for bonds. That means people are, at least for the time being, worried about inflation again, right? Is that an issue with QE2? Is this the reason why these guys wrote this open letter to Ben Bernanke?
No, I think people are worried about bad positioning is what I think they're worried about. I mean, quite frankly, the fact that the belly of the Treasury curve has gotten destroyed just, to me, goes down in part to people thinking that, okay, this is easy money. The Fed said they're going to buy 5s and 10s. I'll buy that. I'll sell 30s. There's big supply next week. That doesn't, or last week. That doesn't matter. I'll just put this nice 10s, 30s curve steepener on and just ride it through all the Fed purchases. And, you know, as always, they just got caught long. And so I don't really think it's an inflation call. I think it's a market positioning event.
All right, let's talk about the markets right now, folks. We do have the closing bell on this Monday, November 15th. It's my dad's 88th birthday, everybody.
Hey, happy birthday.
All right, everybody. We got markets, though, here at pretty much the lows of the session. So call it flat on the S&P 500. So now we're down 3 days in a row, actually. We had a lot of selling on Friday, or a fair amount. A little bit lower there on the S&P, down about 1 point. Check out the Dow Jones Industrial Average, holding on to a slight gain, but it was up nearly 90 at its highs of the session, up about 9 here at the close at 11,202. The NASDAQ, though, like the S&P, a little bit lower here on this Monday, down about 4 points at 25.13. And, you know, I'm going to throw it out to Judd if I can, because, Judd, I want to know what happened in this last hour of trading. You know, we had some decent gains throughout the day, and yet we ran out of steam. What happened here?
Well, here's what I think it is that we actually went into the close on Friday on a negative day. What happened this weekend? In my opinion, not very much that was positive. So the real question was, what happened in the first 5 hours when we were actually rallying? And the reason was, you guys touched on it a little bit earlier with the mergers and acquisition activity. I think that gave a little bit of a bid to the market. But the overlying trend for the last few days is people are trying to kind of lighten up on equities a little bit. I think that Barry hit upon all the fundamentally decent points, but I think we did reach a bit of an overbought situation. The market's a little bit better to sell, and as we got towards the close, those sell orders started to come in. So I look at it as more as like, really, the bigger question was, why did we rally in the first place, not why did we sell off?
Well, you know, let me toss it off to Zara Burton. Zara, you're down there on the floor of the New York Stock Exchange. I mean, were people saying that? Were they wondering what actually bid up the market in the first place today?
All right, here's the deal. In fact, it's about two different things that we're hearing here on the floor of the New York Stock Exchange and just talking to other traders outside of this floor. One of the things is Moody's. It had made some cautionary comments about the U.S.'s AAA credit rating, essentially saying that if the Bush tax cuts get extended permanently, that would be a definite negative for the U.S. economy, and of course that AAA credit rating as well. The second thing I'm hearing as well is Finland and some other smaller countries in the EU are now saying that the EU bailout fund should not necessarily be used to bail out Ireland, because this is a fund that's reserved for just emergencies. That's according to the FT. So that essentially had the dollar strengthening. Of course, the euro coming down. In fact, right now the dollar at a 6-week high against the euro. And like we've seen in the last couple of weeks or so, every time you get a lot of strength in the dollar, you do see stocks come off those session highs. And that's kind of like what you saw today. Also with some of the commodities as well. In fact, gold, oil, and copper, these guys had been higher earlier on in the session. They kind of lost steam throughout the session. And so a lot of the materials and the energy stocks really took us lower on that S&P 500, or weighed on the market, I should say. They were the worst performing groups in the overall S&P 500. And the last thing I just want to mention is volume. 861 million shares that changed hands here on the floor of the New York Stock Exchange today. In the last couple of days or so, we've seen the range from about 900 to 1.1 billion. So light volume, you're seeing bigger fluctuations in the market. I think that's what's going on here, Carol.
All right, got it. Hey, Zara, thank you so much. All right, let's go back to our guests. We've got Judd Pyle and Barry Knapp. I mean, Judd, what do you make of that lighter volume today as well?
Well, part of that, I think, it is Monday. We've seen, I think if you look historically, what volumes have been like on Monday, they're not typically that high. So we'll look and see what we've got tomorrow. As Barry pointed out, we've got a lot of economic data coming out throughout the rest of the week. And then down here, also this Friday, is November options expiration. So I think people were kind of taking their time today to kind of get out their pencils and figure out what they wanted to do. That lighter volume is also a function of the fact that we're through a large portion of earnings season. So you've gotten a lot of the individual company catalysts out of the way. People may have made their fundamental positions, and now they're going to kind of wait until we get to the end of the year. There's a little bit of that going on too, not for traders, but for longer term investors.
Hey, Barry, it's Adam. I just want to mention what Zara was talking about, is that comment out of Moody's where maybe you could see a scenario where the U.S. loses its AAA. Is that crazy? No chance of that? Or are we actually drinking the Kool-Aid and that is a legitimate chance? How do you make sense of that?
Well, we've done a fair bit of analysis on that. And, I think it's implausible that we would lose our AAA anytime soon. However, I do think it's critical that at some point next year, we create at least the perception or get on a path to stabilizing our debt to GDP ratio sometime in the next 5 years. We wrote about that a little bit this week. I think the Deficit Commission plan does that. It actually has the debt to GDP ratio stabilizing by 2014, which would be acceptable. However, it does it by increasing the government revenues as a percent of GDP at 21%. We've averaged 18 since World War II. That, to me, is a pretty unlikely scenario that you would ever get the Tea Party to agree to. So, I think that it's going to be an issue. I don't think it's a near-term issue. I think it's more likely that we reach some kind of an impasse around that in 2011 as opposed to in fourth quarter 2010.
Hey, Barry, it's Julie here. I just wanted to kind of bring it back to the U.S. consumer, if I may. Judd mentioned that we're getting to the end of earnings season pretty much, but we still have a lot of retail earnings. And to that point, we just had Urban Outfitters out, which beat estimates at least on earnings. Nordstrom is just out as well. And we had, of course, the retail sales numbers overall for October today, which look relatively strong. Does that give you some, encouragement that these numbers are looking a little bit better and the holiday season may look better?
Potentially. One of the things I'd be interested in seeing is when Walmart reports, which I believe is tomorrow, what do they say about the low-end consumer? We've had this bifurcation between, if you look at luxury sales, for example, or you look at low-end sales from dollar stores and the like. Those have been a much bigger struggle, in part because the low-end part of the labor market has been under such stress. Now, for 3 months in a row, we've had service sector employment above 100,000. If Walmart makes some encouraging comments on, what's happening around what they call the paycheck cycle, which is sales on the 14th versus the 16th of the month, everyone getting their paycheck on the 15th and spending it immediately. If they were to make some encouraging comments on that, that to me would be very encouraging for the macro outlook going forward. So that's kind of the nuanced thing I'll be listening for this week.
Hey, Judd, it's Dominic here. One of the things that you were talking about earlier, this idea that we could see bullishness of retailers, bullishness with spending and everything. But is this a scenario where a lot of financial advisors say, hey, dollar cost average, right? Buy those dips, kind of just keep on systematically buying stocks here. Is this a chance for people to get in? Did we see a pullback enough for people to say, hey, this is a chance for me to buy a little bit cheaper and ride this thing higher?
I don't think that we've seen enough of a pullback here just in the last 2 weeks. I mean, if you look at where we are, we're still bumping up against our highs for the year. So I think where people really start to dip their toe heavily into the pool is back around the 1115 on the S&P is unchanged on the year. People will start to get really active around the 1150, 1170 area. But yeah, I think that, however, to contradict what I'm saying, if you take a look at some of the individual investor conference numbers, those confidence numbers, those are getting back up towards kind of bullish levels. So you've still got that individual aspect where people are getting involved, and that's, I think, what's provided a bid to this market following the election here.
Hey, Judd, do you think that's likely that we get back to 11.15?
No. I think that where we're likely to close at the end of the year is kind of up 6 or 7% on the year, which is right about where we are right now. So I feel like we're in a bit of a post-election hangover. There was a little bit of buy the rumor, sell the news, and for the next couple of weeks here, we could have consolidation before we get a Santa Claus rally after Thanksgiving.
And Barry, you are upbeat. We know you've upped your estimate recently. I mean, what's the thing, though, that could change your tune here? I mean, is it potentially problems? We talked about the credit rating for the United States. What about Europe? I mean, is that just something you've totally disregarded at this point?
Well, we don't disregard it at all. We think there's a fairly significant credit-related issue going on there. But to me, as long as the data is getting better, exogenous risks like Chinese policy tightening or Europe will not derail the rally. What could derail the rally for sure is on November 30th, the unemployment benefits run out. On Dec 1st, the deficit commissions plans go out. And somewhere here, we have to extend the current tax rates and not lop a huge tax increase on the American public starting Jan 1. That issue's got to get settled. I realize they've just gotten back, but I had a couple of phone calls today with political wonks down in D.C., and I was very discouraged coming off that phone. Maybe it's skepticism or cynicism down there, but we clearly need to get that issue settled. That, to me, would be a game changer if we let that roll into next year.
Hey, Barry, it's Adam. Just quickly, so can you still justify the 1220 target?
It's 1250, actually, and yeah, no, we can. I think that provided we can get this, this issue settled, given the trajectory of the data right now, the bounce of business confidence we expect, I think there's actually a little upside to that. But as I said, those tax cuts are a critical issue.
Yeah, and they're certainly trying to hammer it out, as we reported earlier. Hey, listen, we're going to leave it there. Barry, thank you so much. Barry Knapp over at Barclays, Judd Pyle over at Peak 6 Advisors. Guys, thanks so much.